If you don't know how to play the game or pass the test, you're going to pay more than you need to. And if you go back and look in the past, you might get a lot of money back. But here's one thing I know for sure, is if you just take a little time now, you're going to save a lot more in the future. And we're only talking about one of the areas where people are losing and leaking money, which is tax. Things I've done is I have 3 different companies, so I have 3 different offices for each company. One location where we have coaches that are in, one location that happens to be in the basement of my home, another location that happens to be above the garage where I have a cabin. But now I can write off multiple things, like Augusta rule, more than one property, or when I buy an espresso machine, that's really for the office. I happen to use it personally as well. Like, there's a lot of things you can do that most people miss out on. And look, if you're afraid because you feel like you're going to get audited, or you have an accountant that tells you a few things like, oh, my number one job is to keep you from getting audited, realize if an accountant tells you they're conservative, there's a different word for that called antiquated. They're letting you know that you're overpaying taxes, and when you find out, they're hoping that you don't fire them. Everything I'm going to give you, I've been doing for 20 years, and we've never had an audit go sideways. 1, because we don't do anything offshore, and that does invite a little bit more risk. 2, we're looking at everything you can take advantage of legally and ethically and documenting it. So it's actually very straightforward. But the reason why people get in trouble with the IRS is because they don't report income. If you don't report income that comes in, that's when you do jail time. If you take a tax deduction that was maybe in the gray area and you're not sure whether you could take it or not, if it was less than 20% of your overall tax deductions, you're facing a 9% penalty, right? No jail time, a 9% penalty. That's not a bad interest rate. You're just paying 9% for use of that money rather than giving it to the government. Okay, so if it's a minor thing, just make sure it's documented. But here's where people get into trouble too, is if it's more than 20% of your overall tax deduction, so you take a major tax deduction on something they disallow, there's a 25% penalty. So you just have to look at this and understand, how much of a tax deduction is it in relationship to your overall tax deductions, document it, and continue to ask the question, how does this relate to my business? Now, there's other times where I've been told, oh, well, I can't write things off. We have a client that's a rapper, not our normal clientele. But this rapper said that he couldn't write off all the things he was buying for his videos, including his clothes. And when you read the code, it says, if you could wear those clothes out there in everyday public, then you can't write it off. And I'm like, I don't know that this rapper wears that out every day, but who knows? I don't know a lot of rappers. I'm not hanging out with them normally. It's not, big money for us to work with them, a lot of pain in the ass normally. So ultimately, we just set up a production company. So Jeff, you do documentaries, you have a production company, all of a sudden you could buy props, you could buy uniforms, you can do tons of stuff within that simply because you have the right entity. So the type of entity you choose matters. So the first part to save tax is you build the right team, you meet on a quarterly basis on a proactive manner, you brainstorm and they tell you whether you can do that or not, and then every 3 years get a different set of eyes and go back and see if there's something. You can look at R&D credits, domestic production credits, anyone selling things internationally. So if you sell things internationally, you should look into an international sales corporation as well because you can cut your taxes in half on that. All right, the third category, so the second one was deductions. The third category is the game changer. It's called reclassification, and this is why 100% of entrepreneurs that don't understand this will overpay their taxes this year. In the past, we found 93% of people overpaying their tax, but with the new tax plan that came in from Trump, we're finding pretty much everyone's missing out on this. Reclassification has 4 key areas. The first area is how do you take your active income and make it passive. Passive income could be you choose an S corporation. You pay yourself a reasonable salary, which is what would you pay someone else to do your job, not what you're worth. And you take the rest in distributions. Those distributions avoid self-employment tax, which saves you at least 3.2%, and for many of you, 15.3%, just how you write the check to yourself, right? So that's turning active income to passive. Or if you owned your building, you could charge yourself a high rate. Or if you could do anything that creates investment income versus active income, it's going to lower your taxes. The second thing is taking ordinary income and turning it into capital gains. So Trump misquoted this when he was in the debates with Hillary. He said, Warren Buffett pays less tax than his secretary. That's actually not true. Warren Buffett pays a lower tax rate than his secretary, but pays more taxes. The reason he has a lower tax rate is almost all of his income comes from capital gains, which is half of the rate of what his ordinary income would be. So 2 ways you can do that, just as examples. That international sales corp, anytime you're selling something internationally, you run it through an international sales corp, and that will be taxed at capital gains instead of ordinary income. Or anyone heard of a captive insurance agency before? So you can actually put money in pre-tax into something like that, hold on to it for at least 12 months, but if you don't have an insurance claim, it's you and your money that's your insurance policy, not an actual insurance policy. You're the company. If you don't have that claim, you get to take it out as a capital gain, therefore cutting your tax in half, right? So that's ordinary income to capital gains. The first one was taking active to passive. The third one I like even better. The third one is how do you take taxable income and make it tax-free? Anyone against that? All right, so here's how you do it then. Charitable trust would be one of the ways you could do it. So let's find any charity that you feel any affinity for, that you like. You can actually donate highly appreciated assets like businesses, real estate, or stock, and when you donate it to the charity, you get a partial tax deduction the moment you donate it. You don't have to sell the business or sell the real estate. You get a partial tax deduction for the donation. When you sell the business, there's zero tax upon the sale, none. And it funds this trust. You're the first one that benefits from the trust, not the charity. And you can take between 5% or 50% income off of that full sell per year, depending on how you invest the money and how well the investment does. So rather than paying tax, you're getting a tax deduction. Zero tax when you sell it, you get a benefit from it your entire life, and when you die, the charity is supposed to keep at least 10%. So would you rather give the charity of your choice 10% or the government 37%, right? So that's one tax-free strategy. Another one could be, if you want to sell your business but not to some outside entity, you can actually use something called an ESOP, Employee Stock Option Program. You could sell your business internally to your employees. Banks will actually finance it for you, and you'll pay no tax when they buy that stock. That's another example. Or an installment sale when you go to sell your business. Look, anyone in here that ever plans on selling their business, you need to know what your tax strategy is today, not when you sell. 2 out of 3 business owners, when I go speak, that are saying that they're selling their business cannot take advantage of all of the tax advantages out there because they already have a letter of intent. They already have a broker. They've already moved forward with it and thought, oh, I'll deal with the tax after I sell. The bottom line is that is going to cost you at least 50% on the tax by not having the strategy ahead of time. And for some people, it's going to cost them a whole amount of tax that they could have completely eliminated. All right? So, got to know the tax strategy. So on this reclassification, it's how do you turn active into passive. Then it's how do you turn ordinary income into capital gain, taxable income into tax-free income, which, by the way, as an entrepreneur, it's a phenomenal thing for you because the first 300 pages of the tax code tell everyone why they have to pay tax. The next several thousand pages say why you don't have to pay tax as a business owner. That's how it works. If you don't know how to play the game or pass the test, you're going to pay more than you need to. And if you go back and look in the past, you might get a lot of money back. But here's one thing I know for sure, is if you just take a little time now, you're going to save a lot more in the future. And we're only talking about one of the areas where people are losing and leaking money, which is tax. Now, the fourth strategy of reclassification. The fourth strategy is the tax arbitrage strategy. So that's anytime you can spend $1 and get more than $1 back. That's anything from solar credits to film credits to, like we had someone in West Texas that recently came to one of our workshops, and they had a bunch of land in West Texas that they told me was worth nothing because they said it was just empty. The reality is it had a bunch of sand, and sand is required for fracking. And so what we did was we went in and had it evaluated that if they were to develop it and use the sand, what would that be worth? And they got a 6.5 to 1 deduction. So for the price of the land, they got a 6.5 times tax deduction, essentially putting a bunch of money in their pocket and a lot more than what they paid for it. There's other people that actually own buildings in historical neighborhoods, and you can actually donate the facade of the building, and of all places, it's the Forest Service that determines the value. I mean, I can't even make this shit up if I tried. It was like, what's a weird way to do that? Oh, the Forest Service, great, let's, yeah, that makes sense. So you actually go and they say, here's what that's worth, and you can donate the facade of the building, still renting it out, still renting to yourself, to other people, but you get a tax deduction if you agree to never tear it down and you preserve the look of that building. That's tax arbitrage. The whole art strategy of, I bought $2.2 million of art for $300,000. And then after owning it for 3 years, I can donate it to any of the museums that I want, and I get back basically $600,000 in tax credits or $2.2 million of tax deduction.